What happens when you think you're right, make big bets, and lose billions? Well, that's exactly what happened to the Nostradamus of AI. Find out my thoughts on this edition of the Video Market Update. So a former OpenAI or ChatGPT engineer, a 24-year-old young man named Leopold Aschenbrenner started a new hedge fund called Situational Awareness. He took his knowledge of AI and used that to invest around artificial intelligence. And his thesis was, let's go down the supply chain and invest in microchips and data center and infrastructure and cloud computing, all the things that AI companies need in order to, function. And initially, it's reported that his fund was quite successful, earning as much as 1,000% return. But when you peel back the layers, you see that the way he was making such enormous returns was something called leverage and margin. Leverage is a fancy word for risk, and margin is a fancy term for debt. So the way leverage in this case works is you 4 or 5 times a position. So if a stock were to go up 25% and you have leverage on that, you could make up to 100%. But the inverse is true. If a stock goes down 25%, you could lose 100% of that investment. And so that's very risky. Add on more risk of saying, well, I don't have the money to buy all this stock, so I'll go and get margin, or I'll borrow money from a bank or a lender to buy additional shares. Well, when those big bets reversed and some of those companies were down 10, 15, 20, 25%, what happened? He saw a huge drop in the value of his holdings, and it spooked the lenders, the banks, who said, we want our money back. So they did what's called a margin call and asked for all of it back. And so to scramble to save his firm, what did he do? He had to go find another hedge fund who was much bigger, much more patient, and much more cash healthy, who bought all those positions. And so his fund went from 45 billion in assets down to 10 billion. And this happened within a matter of days. Now you may say, oh, I'm not gonna feel too bad for somebody who still has $10 billion. Of course, I could see where you would see that and feel that way, but it's really the point of he almost lost his firm that he had built fairly successfully in just a matter of days because he had too much leverage and too much debt. If you think back on most of the catastrophic things that have happened economically in this country, think Great Depression, think 2000, 2001, 2002, 2008, most of that was based on way too much debt and people using way too much debt to buy stocks. So that's why we do not recommend any leverage products, which surprisingly are available for everyday investors like you and me. We don't advise or recommend people use margin. Surprisingly, that's available for everyday investors like you and me. But this is really a cautionary tale to remember that the best way to get rich, sadly, is slowly and probably boringly. It's not to get rich quick. Generally speaking, that doesn't tend to work. In this case, it almost cost him his firm and his investors money. Hopefully, we don't suffer from that same, and that we are patient, serious, long-term investors. But I thought it was an interesting story because you see this a lot where these people are labeled the wonderkin, and it works really well for a while. But then what happens? You have to pay the piper, and in this case, it almost cost him his firm. So interesting. Thought you might find that interesting as well. If you have any questions on this or anything you're seeing in the market, let me know. But if not, as always, I hope you make it a great week.